Hi, I'm Dave Nolan, Senior Investment Strategist at McKinley Carter Wealth Services, where we continually endeavor to help you master your wealth. Today, I'd like to highlight our third quarter market review and outlook report. We titled our last quarterly report, Bloodied but Unbowed, reflecting a stock market that we believed overcorrected in a short period of time due to fear of rising interest rates and inflation and the impact of the war in Ukraine. Subsequent to our report, the stock market rose nearly 14% from June 30th to August 16th, where the rally ended and prices began to fall again due to concerns over new inflation data. Unfortunately, when the Federal Reserve recently met expectations by increasing the federal funds rate by 0.75%, they did indicate their intention to press short-term rates markedly higher than their previous targets. And this declaration upset both the stock and bond markets. Complicating matters, Fed Chair Jerome Powell stated that economic pain may be the price for bringing down inflation. Currently, the markets are focused on three things. One, when will inflation officially peak? Two, when will rates stop going up and how high will they go? Three, how severe is the economic slowdown and what is the impact on corporate earnings? As to when inflation is going to peak, the August Consumer Price Index report was disappointing and reflected still high food, housing, and medical costs. Also, elevated wage pressures may continue for some time due to a workforce participation level that's still lower than pre-pandemic levels. However, many commodity prices are in sharp decline, such as oil and gasoline, which peaked in early June at levels well above current prices. Additionally, other important commodities such as gold, silver, copper, uranium, lumber, wheat, soybeans, cotton, and milk peaked between March and May of this year. The price for another important commodity, steel, actually peaked in October of last year. Supply chain bottlenecks, which have been cited as a source of inflationary pressures, have also lessened significantly as of late. Furthermore, home prices may well be peaking as building permits for new homes, a good indicator of housing activity, have recently fallen sharply. Evidence that inflation expectations over the next few years are declining can be found in the chart of the 5-year break-even inflation rate, which gauges how markets are pricing in inflation risk over the next 5 years. The current expectation for 5-year inflation has fallen to 2.26% from 3.59% in March. It is back to levels last seen in February of 2021. Reflecting on interest rates and when they might stop going up, the terminal rate, where Fed rate hikes are projected to end, is now estimated to be at 4.6% and happened in the spring. The Fed has indicated they would like the Fed funds rate to be at 4.4% by year end versus 3.1% today, a level much higher than they forecast just a few months ago. The stock and bond markets are under stress as a result of the Fed constantly moving the goalposts of rate increases. As far as the outlook for the economy and corporate earnings goes, there's no question that growth is decelerating globally. And the U.S., while in a better position than most other countries, is certainly not immune. With the Fed strongly indicating that fighting inflation is far more important than the fallout of a potential recession, risks to the U.S. economy and earnings have risen significantly. Recently, analysts have been lowering their earnings estimates for the S&P 500, and those negative revisions have led to downward pressure on markets. Hurt by a 20-year high in the U.S. dollar, estimates for this year and next are now indicating little growth outside of some good earnings from the energy sector. While we don't believe that the U.S. economy is currently in a recession, with very low unemployment, historically low unemployment claims being filed, and retail sales holding steady, we acknowledge that the odds of a recession happening over the next year have increased markedly as a result of the recent dramatic rise in interest rates. Our position on the equity markets is one of caution over the near term, as investors factor in the impact of rising bond yields on the economy and stock prices. As more evidence of declining inflation is reflected in future consumer price index reports, we believe markets will stabilize. The stock market is a discounting mechanism of future earnings, and when the Federal Reserve is no longer acting as the market's adversary, stocks will likely find their footing. However, should the Fed maintain its aggressive policy towards interest rates well beyond the point that compelling evidence of a decline in overall inflation is seen, equity markets will likely experience a more prolonged downturn. In fixed income, we believe that Treasury bonds that pay interest rates above 4% serve as strong competition stock prices as investors lock in government guaranteed returns. In sum, While markets continue to be challenged by rising rates and economic uncertainty, history shows that investors who take advantage of significant pullbacks in stocks during troubled times for the economy and periods of excessive investor pessimism, as we see now, are generally rewarded over longer periods of time. Patience, while difficult in the moment, is always the best path to long-term wealth building. Thank you for watching today, and please read our full market review and outlook report for greater detail on the third quarter and our forecast for the rest of 2022. Take care, and we'll see you next time.